gold will go the fastest and silver will go even faster. Until ultimately, in my opinion, this is my opinion, we get to a 15-to-1 and that'll be the bell at the end. And then credit will be dead. We'll just move to money and then we'll have to rebuild. And we will. And it'll be difficult, but we'll do it. So Daniel Oliver of Myrmikan believes that this is it, that this is the last round, that the last round began in 2020. And the next inflation round is not going to inflate credit. It's not going to inflate the purchasing power of the dollar. When I mean inflate credit, I mean inflate the purchasing power of the market cap of dollars that exists, right? So more stuff can be bought by the existing dollars than the existing gold stock. That's, I guess, broad strokes how to put it. So his theory is that this is the last round because in the next round, what's going to happen is that most of the money that's being printed or the dollars that are being printed will stay within the U.S. as foreigners who have treasuries will sell and dump the dollars into the U.S. for other currencies or other real, rather real assets, I would say, because other currencies are just dollar derivatives. And that will just, that'll change credit inflation to just simple debasement that he calls it, which is just rising consumer prices and assets will continue to fall in gold terms rather than rise in gold terms, or they will fall in gold value rather than rise in gold value. So the evidence that Daniel Oliver cites is that when a central bank has control, they can lead long-term rates down by cutting short-term rates, by cutting the Fed funds rate, as we call it. And in other rate cutting cycles that have happened since 1980, since this huge, broader rate cutting cycle started in 1980, long-term rates always went down in tandem with short-term rates. If the Fed engaged in a rate cutting cycle, then almost immediately or even beforehand, the long-term would front-run the short-term as traders would buy bonds anticipating that the Fed would cut, or the Fed is cutting and looking for, make a profit. So they would drive long-term rates down even faster, even further. And that was the case until now, until 2024. The last rate cutting cycle started in 2024. It hasn't been huge money printing yet, but we definitely have started the easing cycle. It's a year and a half old now, but long-term rates are higher since then. Right, long-term rates started at 3.75, if I remember correctly. 10-year yields were 3.7, 3.75 when the rate cutting cycle started, and now they're 4.1, 4.15. So I think they went as high as 4.4, as high as 5 actually at one point. Or was that before? No, yeah. Since the rate cutting cycle started, I think they went as high as 4.2, 4.3. But basically, the point is that long-term rates have risen as short-term rates have fallen, and that's the first time this has happened since 1980. So the Fed is starting to lose control. Once they cut to zero and they see that 10-year yields aren't falling, then they're going to have to buy a whole bunch of bonds. And they're going to have to buy so many, in Daniel Oliver's opinion, that it's just going to be pure debasement, and we're going to start seeing consumer prices just fly higher. And maybe asset prices will climb a little bit, but not relative to gold.
Farber says the Fed lost control for the first time since 1980. Long-term rates rise as short-term fall. Proof. The bond market is breaking. Next banking crisis, they cut to zero and print. But this time, it's pure debasement, not credit. Gold and silver explode. Silver to 15-to-1 gold ratio. Open interest at 400,000 levels seen only at major bottoms.
And right now it's about 400. I think the last I saw was 406,000. So usually they're between, let's say, 450 and 550,000. That's like that's the range that's been in place for 10 years. Sometimes it gets below that. Sometimes it goes above. But the last time we were at about 400,000 was like 2 or 3 times since bear market bottom in 2015 when gold was like $10.45 an ounce, $1,045. So what 400,000 signals to me is that these speculators are mostly gone from the market. They see the backwardation in silver, I'm using that word not how I define it, but how people generally use it. Backwardation is higher spot prices for if you want to buy actual metal than futures price if you want to contract future delivery. So because silver is more expensive in the spot market than it is in the futures market, then that means that you can't hedge your short positions in silver. And bullion banks will see that and they'll say, look, I don't want to do this right now and short in the futures market and go along in London because I don't know how long that spread is going to be positive, right? It's getting thinner and thinner and thinner, so it's more dangerous to do that even if you're hedging. And I think that's the main reason why a lot of coin shops have shut down, and they're not able to buy constitutional silver anymore from the public because they'd have to send it to a refiner, and the refiner would have to hedge that inventory in order to ensure a profit for itself, and they can't hedge because the spot price is higher than the futures price. They can't do it, so the refiners can't take it, and therefore the coin shops can't send it to the refiners, so the coin shops can't take it from the public. That's the bottleneck that's happening. So anyway, back to the open interest. If the bullion banks are reluctant in this kind of environment to make a market, that's what they're called, the market makers, to make a market in gold, and it doesn't mean that none of them are, it just means they're doing it less, then price is going to move on a small move in open interest. So the volatility is going to last a little while longer. I don't know how long, but the volatility doesn't mean that there's a huge amount of speculators in the market. There aren't. So my thesis is that while we still might be a little bit away from a bottom in gold in terms of time, I don't think we're far away in terms of price. I don't think we're going to get much farther from where we are now. For gold, I think we're at 4,900 now. I think we're going to float between, let's say, 46 and 52, where we've been bobbing up and down since the mini crash in the end of January. I don't think it's going to change much from that. Foresee it. I'm just looking at the chart of silver, and I see what happened in 1980. I see what happened in 1918. I see what happened in 1968. And I see what happened in 2011. I was like, something like this is probably going to happen again. When it changes, and backwardation in silver it becomes permanent and then moves into gold, and then the prices for spot keep going higher and higher and higher, and the prices for futures keep going lower and lower and lower relative to the spot. Then I'll say, okay, you know what? I think this backwardation is just going to keep getting worse and worse, and that's it. And I think we can batten down the hatches, and I'll sign off and nuke my channel, and maybe I don't know. And then I'll say that's it. But we're not there yet. But when we get there, we'll get there quickly. And I think we're going to get there once we have the next banking crisis, and the Fed has to cut to zero, and you'll see that the Fed funds rate will be slammed to zero by Warsh or whoever's going to be in charge. Kevin, I think his name is Kevin Warsh. And the 10-year yield will not fall like it did in 2020 as sharply. And then the Fed will start to panic and announce that it's buying a whole bunch of 10-year yields to try to push the yield down on those. And then that'll be it. At that point, I'll say, look, guys, this is it. This is your last chance. Do it now or forever hold your dollars. You can frame them on the wall or use them for firewood or whatever. Or, hold your Bitcoin, and I don't know what you could do with that. So we're close because there's only one more step to that. I just don't know when it's going to happen, but I know that it's the next step. And I remember I was just walking into my house and thinking like this could happen at any time now. We'll hear of a bank falling over the weekend or something. I mean, that's how the March 2023 regional banking crisis happened. All of a sudden, I woke up in the morning and I saw all these messages saying, Silicon Valley Bank fell. I'm like, what is Silicon Valley Bank? And then I looked at it. I'm like, well, okay, well, something's happening. Well, that's what it's going to be this time. Some bank is going to signal some SOS distress signal, and then other banks are going to say, and then we'll be okay. Well, this is it, guys. It could be any time. A lot of people who have seen the past cycles in gold and silver, they say, they go up, and then the Fed cuts, and then everyone thinks they go up, but they go down because credit's reinflating, the purchasing power of credit's reinflating, and so that's probably what's going to happen this time. So why should I buy gold and silver mining stocks now when gold is about to fall? This has happened before. But that's not going to happen this time because I believe that Daniel Oliver is right of Mermacan Capital, and this next printing round is just going to bring gold even higher. And the importance of mining stocks, if you believe that you'll retain ownership of them through whatever great taking might happen, is that they will be able to pay you in real money dividends in some form. Whether you'll get them through the endgame process or not, I don't know. But these are real capital that produce real money, and other companies won't be able to pay you dividends, but they will, and a lot of them will honor that. Some of them might not, but you know, put your assets in different things that might pan out, and gold and silver stocks might pan out. And the definition of money is the most liquid commodity that exists in an economy. The reason that we call the dollar money is because it stands in for the most liquid commodity, which is gold and silver. And now there's a whole bunch of inflation on top of that. But essentially, when you get down to the nature of what a dollar is, it's a dollar derivative. It's a gold derivative. It's a ticket for a certain amount of dollars. And still technically, it's a ticket for $42.22 an ounce of gold. That's what it is. Everything else is inflation on top of that core, right? Dollar isn't a fiat currency in the sense that it's all nothing. It's a little bit of gold with a huge air bubble of inflation on top of it. So when I say I'm holding gold and silver for for good, and I'm not going to sell it. Well, I am going to sell it. There's no point in holding on to gold and silver until I'm dead. And what's the point of that? It's, so what? I may as well hold up the dollars until I'm dead, whether I have a stack of paper in somewhere hidden, or I have a stack of metal somewhere. What's the difference if I don't use it? It doesn't make a difference. So I do plan to sell my gold and silver, except I won't sell it for dollars. That doesn't make any sense. I plan to sell it for stuff, and then take that stuff and, I don't know, build an empire. I'm not going to build an empire. I'm not an empire builder, but I have certain values, so I'm going to spend my resources on trying to get those values realized in the world, and I think this is my chance to do it. So that's what I'm going to do. I'm going to spend. So, back 1 second to the definition of money. Money is the most liquid commodity. The most liquid commodity in an economy means the commodity that people want to buy and sell the most of at the same time. It has the most liquidity, the most buy and sell orders simultaneously. So when I spend gold and silver, I'm selling it. I'm going to sell it, except instead of for derivatives of that same commodity, I'm going to sell it for other things. It doesn't take a huge amount of chachma to figure that out. It's just like you have to be able to balance yourself as a silver bug and not force yourself to constantly be cheering the prices going up, because that's the business that we're in. For better or for worse, that's what we do. We encourage people to buy, to exchange their gold and silver derivatives for actual money. And it's hard to do that when you're saying, well, there's going to be another pullback, but you have to be honest and sometimes and say, well, there probably is going to be. So I said there was going to be. I didn't know when. But it makes sense. I'll change that thesis and I'll say there's going to be no more pullbacks when I clearly see that everything is falling apart right in front of my eyes. I see all the setup for it now, but people are still buying food in the supermarkets. People are still driving cars and buying gasoline. Things are still basically working. Nobody's starving to death in the streets or anything like that. And as much as we know that everything is messed up, like seriously messed up, still you wake up in the morning, you do your daily stuff, and then, you come back home, you go to sleep, you wake up the next day, it's basically the same, even though you know all this stuff is going on in the background. But eventually that's going to change, right? But it's going to happen. And when it happens, I'll probably call, that's it, grab your stacks, is your last chance.
I did want to ask you about silver mining stocks and gold mining stocks in this environment here. We have had a lot of people mention how, they didn't really make the same sort of move. At least a lot of them didn't make the same sort of move as the physical metal. And as we've seen this pullback, they also haven't dropped. A lot of them haven't dropped as much as the physical metal. So if we do start to enter like an end game type scenario, what is your take on that? Do you anticipate them outperforming, or would you prefer just to have kind of all your assets outside of the system, nothing tied to kind of the paper market at all?
No, I don't do that. I'm not going to put all of my assets outside of the system or all of them into the system. Like, I don't do everything anywhere. I don't. I'll put some in bullion, a very small amount that I have with me, just for emergencies, nothing big. And the rest I'll have somewhere, that I don't have immediate access to, but I don't have to worry about it getting stolen. And people say, "Oh, there's the great taking," and you don't really own it because the brokerages they hypothecate or rehypothecate or rehypothecate or whatever they say they do, and they probably do. So you can argue that, oh, your mining stocks aren't going to be worth anything. Maybe they won't be. I can't really. I'm not going to think in those directions. Like whatever happens to them happens to them, and if I lose them all, well, I have bullion, so fine, whatever.